All right, let's get right into it. There's this hidden mathematical trap in investing that almost nobody sees. I remember the first time it really clicked for me. I was looking at a trade that went wrong. It wasn't a huge loss, but the damage to my portfolio was way bigger than it should have been. I'm staring at the numbers, and it just didn't make sense. And that's when I found it, the math of ruin. It's like this invisible force, this financial black hole that can just suck you in. But here's the cool part. What if I told you there's a way to not only avoid it, but to actually flip it around and use it to your advantage? Well, that's exactly what we're going to break down today.
And of course, we got to start with the legend himself, Warren Buffett. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, this isn't just some cute quote for a coffee mug. It's basically the first law of investment physics. See, Buffett saw brilliant people get absolutely wiped out in crashes, and he figured out that the secret to getting truly wealthy wasn't chasing some crazy high return. It was just obsessively, relentlessly avoiding the big losses. This isn't about being scared or timid. It's about knowing that your capital, the money you start with, is the foundation for everything. You lose that, and the whole game is over before it even starts.
So let's start by digging into this unseen danger. I want you to think of this like we're financial detectives, okay? We're on the case, looking for the clues that reveal this hidden math, this thing that trips up so many investors, even really smart ones. It's this subtle, kind of backward force that punishes you for losing way more than it rewards you for winning. It's why in investing, a good defense isn't just important, it's everything.
Okay, so let's define our terms. When most people hear the word risk, they immediately think of volatility, right? The market jumping up and down like crazy. But that's not what the pros worry about. Buffett's definition is way more powerful. Think about it like this. You're on a road trip across the country. Volatility, that's just some bumpy roads in the mountains. Annoying? Yeah, but it won't stop you from getting to your destination. The real risk, the one that actually matters, is running out of gas in the middle of the desert. That's a trip-ending event. That's what real risk is. It's not the bumpy ride. It's the possibility that after all this time and effort, you just don't make it to your goal. That's the ultimate failure.
And this all boils down to one simple idea. Risk and control are opposites. They're on a seesaw. The more control you grab, the lower your risk goes. It's that simple. So think about it. Instead of just buying a stock and, crossing your fingers and hoping it goes up, you can take control. You can decide before you even buy where you're going to sell if things go south. That's called a stop loss. Bam! You've just put a hard limit on your potential loss. You're in control. But what do most people do? They just hope. And let me tell you, the second you hear yourself saying, "I hope this works out," about an investment, that's a massive red flag. That's the sound of you giving up control. You're not investing anymore. You're gambling.
All right, let's get real for a second. Imagine you open your account and you see this number staring back at you. Negative 50%. It's a total gut punch. I've been there. During the dot-com crash, I watched a sure thing tech stock literally get cut in half in what felt like minutes. It's a sickening feeling. It happens, right? It happened in 2008. It happens in every major crash. But the real kick in the teeth isn't the loss itself. No, the really brutal part is the math of what you have to do to get back. So let me ask you this question, and just think about it for a sec. Your portfolio loses 50%. Let's say you started with 100 grand. Now you have 50 grand. What percentage gain do you need now just to get back to even? Your brain probably screams 50%, right? Lose 50, gain 50. It feels right. It feels logical. But it's completely and very dangerously wrong. The answer is 100%. You need to double your money just to get back to where you started. Think about that. It's like falling into a 50-foot hole, but to get out, you have to climb a 100-foot wall. This is that brutal lopsided math I was talking about. Losses hurt you way, way more than gains help you. A 50% loss isn't just a bump in the road, it's a giant crater, and the climb out is twice as hard as the fall in. And what happens if you keep taking hits like that? Well, eventually, you hit the point of no return. It's called the risk of ruin. The best way to think about it is a poker game. If you lose all your chips, the game is over for you. You can't just say, "Oh, I'll wait for a better hand." Nope, you're out. You have to leave the table. It's the exact same thing in investing. We're not talking about having a bad year. We're talking about game over. It's a mathematical wall, a point, like hitting zero, that you just can't come back from. You've lost everything, including your ticket to play. And check out how fast this gets scary. Look at these numbers. If you only risk 1% of your money on any single idea, you'd have to be wrong 100 times in a row to go broke. Pretty hard to do, right? But just bump that up to risking 5% per trade. Now it only takes 20 straight losses. Still unlikely, but possible. And what about 10%? That's it. 10 bad decisions in a row and you're done. You're out of the game.
That's how critical position sizing is. It's not a small detail. It's the difference between staying in the game and getting wiped out. This leads to one of my favorite analogies ever, from Nassim Taleb. He calls it the turkey problem. So picture this. You are a turkey, and for 1,000 days straight, this nice human comes and feeds you every single day. What does your data tell you? It tells you that humans are great. Life is good. Your confidence that tomorrow will be just as awesome as today gets stronger and stronger. Right up until the day before Thanksgiving. And then suddenly, your model of the world spectacularly fails. That's exactly what it was like for so many people before 2008. The market was calm, everything looked great for years, and then bam, the subprime crisis hits. It's the perfect example of how a long stretch of good times can make us completely blind to a huge catastrophic risk lurking just around the corner.
Okay, so that's the scary part. That's the math of ruin, this monster hiding in the closet. But now for the good news. Because there's a flip side to all of this. There's a way to take that destructive power and turn it into a creative one. If ruin is the villain, we've found its kryptonite. It's a concept called asymmetry, and it is a total game changer.
So what the heck is positive asymmetry? It's actually super simple. It's any situation where your potential reward is way, way bigger than your potential risk. The classic example is a venture capitalist. They invest in, say, 10 companies. They know, going in, that 9 of them are probably going to zero, total loss. But that 10th one, if it hits, it could be the next Google. That one massive winner doesn't just make up for all the losers, it makes the entire strategy wildly profitable. You're risking a little to make a lot. That's the core idea. You cap your downside, but your upside is wide open. This is the antidote to the math of ruin.
Let's break this down with some real-world examples. On one side, you've got these terrible, negatively asymmetric bets, like speeding to save 5 minutes. Best case, you save 5 minutes. Worst case, catastrophic. Or in finance, something like selling uncovered options. You collect a tiny bit of money for taking on potentially infinite risk. Just a terrible trade-off. But on the other side, that's where the magic happens. Positive asymmetry. Starting a business, yeah, you could lose your investment. That's your capped downside. But the upside? It's practically unlimited. And look, just buying and holding stocks is on this side. Why? Because the most you can possibly lose is what you put in. But a great company can go up 10, 20, 100 times. That, right there, is a beautiful asymmetric bet.
All right, so this all sounds great in theory, right? But how do we actually find these kinds of opportunities? How do we go hunting in the market for these companies that have that asymmetric potential baked right into them? Well, let's talk about that.
Well, for starters, you're probably going to have more luck looking at smaller companies. And it's not because big companies are bad, it's just math, the law of large numbers. For a company that's already worth $1 trillion to double, it has to create another $1 trillion in value. That's insanely difficult. But for a little $100 million company to become a billion-dollar company, that's a 10-bagger right there. It's still really, really hard, don't get me wrong, but it's possible. I mean, think about Amazon back in the day. Just a tiny, unprofitable online bookstore. Nobody took it seriously, but it had the seeds of greatness. That's where you find those monster returns that can change your life. But this isn't about just blindly betting on penny stocks. No, you're looking for a very specific set of ingredients. You need a checklist. First up, does it have a moat, a real, durable, competitive advantage that keeps the competition away? Next, can you see a clear path to massive sales growth? The story has to be believable. Third, is it a disruptor? Is it changing the rules of its industry? And finally, and this one's crucial, is it plowing all of its money back into the business to get bigger and stronger? Because that's the fuel for the whole compounding machine. And just to give you a sense of how hard growth is at a big scale, look at this. There was a time when Amazon's stock price basically implied that the company had to grow 74% every year. And man, I've been there. You see a hot stock, everyone's making money, you get that FOMO, and you're so tempted to dive in even when part of your brain is saying, this is crazy. But do the math. For a company that big to grow that fast, I mean, its revenue would end up being bigger than the entire economy of France. Does that seem likely? Doing that little reality check is so important. It reminds you why you have to find these companies when they're small. Okay, so we know the danger, the math of ruin, and we know the solution, finding asymmetry. But there's one last piece to this puzzle. It's not enough to have a good offense. You also need a rock-solid defense. You need the right mindset to protect yourself and stay in the game long enough for your strategy to work. And a huge part of that is this idea of skin in the game. It's so simple, but so powerful.
It just means that the person making the decision has to live with the consequences if they're wrong. A ship's captain goes down with the ship. They have a very personal stake in getting it right. It's the best filter there is, because it aligns everyone's interests. You want to listen to people who feel the pain if they're wrong, not just the people who get a bonus if they're right and walk away if everything blows up.
This is the perfect illustration. On one side, you've got the banker. He sells some complicated financial product. If it works, he gets a massive bonus. Heads, I win. If it fails and blows up the economy, well, the government bails out the bank. Tails, you lose. He has no real skin in the game. Now look at the airline pilot. Heads, she lands the plane, everyone's safe, she gets paid. Tails, she doesn't get to walk away. She has the ultimate skin in the game. It's pretty obvious whose advice you should trust, right?
And for the absolute best example of this, look no further than early Warren Buffett. In his original investment partnerships, his deal was this: he didn't make a dime unless he made his partners at least 4% a year. Above that, sure, he took a cut. But, and this is the amazing part, if he lost money in a year, he had to pay his partners back for a quarter of their losses, out of his own wallet. I mean, talk about skin in the game. That's the definition of a manager who eats their own cooking. He wasn't just risking his clients' money, he was risking his own.
All right, let's bring this all home. We've talked about the danger, we've talked about the antidote, now let's make it actionable. Let's talk about the actual tools you can use to build a financial fortress around your portfolio.
Here's a simple framework with 4 key steps. First, master your position sizing. We already saw how important this is. It is the #1 thing that controls your risk of ruin. Keep those bets small. Second, always have an exit strategy. You are the one who controls the sell button. Use that power. Decide on your exit before you enter. Third, use hedges or insurance for the things you can't control, like a massive market crash. And fourth, diversify. You have to. It's just admitting that you're not going to be right every single time and making sure that no single mistake can ever take you out of the game.
So I'll leave you with this one last question to think about. When you look at your own portfolio, are you just hoping for the best? Or do you have a real plan? Are you building something that's designed to survive, that controls risk, that actively hunts for those incredible asymmetric opportunities we've been talking about? Because at the end of the day, hope isn't a strategy. The good news is you have the control to build one that is.